is where we are at. So it's a good start, bang in line with what the SGX was telling us. Harsha Upadhyaya is now joining us, Chief Investment Officer, Equity at Kotak Mutual Fund. Harsha, great to have you with us here on the program. Thanks very much for your time. What's your view on the news flow with regards to the big blocks that we've seen yesterday in the Adani Group companies? Now, our question is not so much about what to do with any of these companies, but as a market participants, as a fund house, how would you view this in the broader scheme of things? Because this did sour sentiment quite a bit. What was happening over the last one and a half odd months or so? Will this put a stop to it, at least in the near term? Your sense?
Good morning, Prashant. Clearly, we never speak on any individual company or a group. So to that extent, I will not make any specific comment on the group or the stock, but definitely the overhang that the market was seeing in terms of short-term volatility related to the news flows seems to be kind of behind us, at least for the short term. And that's good. But obviously, a single day move cannot be extrapolated into next few weeks or next few months. We'll have to keep watching out on the fundamentals and how they shape up over the next few weeks, few months to really see the direction of the market.
Hi, Harsha. Good to have you on the show, as always. So give us your overall sense on the market, because it's been testing, right? It's not been an easy one to navigate in this year so far. So how are you looking at incremental additional deployment? Are you still keeping cash levels a little higher, or are you fully invested? What's the approach?
Surabhi, we never usually take any cash calls to manage our portfolios. Rather, we keep very manageable levels of cash just to manage the liquidity issues at the portfolio level. So to that extent, we remain fully invested even at this point of time. Yes, if you look at our portfolios are cautiously optimistic in terms of economic recovery in the domestic market. Most of our positions are looking at businesses that have serious linkages in terms of domestic growth recovery. And to that extent, we believe that this is the basket which will be resilient in terms of earnings growth and also has room for valuation re-rating if economic recovery follows.
Hi, Harsha. Good morning. Harsha, the sector that got hit the hardest was the banks. And it was ironic because they came out with probably their best quarterly update in a long while. And post that, the stocks took the hardest hit. So the worst possible reaction. Now you have some bit of, fundraise from the Adani Group promoters, which if it was a sentiment positive, then it's good. It's playing out quite well. Post this correction on the Nifty bank itself, I think it's a 10% correction from the top. Are some of these stocks now looking good? If you are positive on the domestic cycle, if in fact you expect things to improve from here on, then which banks would you play?
Nigel, we have remained quite positive on the banking sector as a whole. And within banking, we prefer larger banks because clearly there is a scramble for low-cost deposits. And to that extent, larger banks will be in a position to handle that better than some of the regional banks or NBFCs. So our positioning hasn't changed despite the volatility in the market. But just to step back and see what happened actually, the banking sector was one of the best performers during 2022. And towards the end of the year, we did see a tactical shift from foreign institutional flows from India to some of the other markets which had underperformed in a big way. For example, China, Taiwan, Korea, etc. So to that extent, those who had made money on the banking stocks, and generally most of these portfolios were having reasonable exposure to banking, obviously sold some of those names. And to that extent, we did see in the past couple of months, especially year to date, banking sector underperforming the broader market. But we won't read too much into that because clearly I think this is going to be one of the sectors which will deliver better than market earnings growth, and also there are no big asset quality issues at this point of time. So to that extent, we believe that this is likely to outperform the overall market, and we continue to hold our positions in the sector.
Harsha, you guys have been a little cautious, right? I mean, last few interactions that we've had, you, Nilesh, etc. on. What's your prognosis? I mean, the fact is that interest rates are going up, right? Not just in the US, but here in India as well. So is it likely to kind of remain a range-bound equity market? I mean, is the environment very conducive, or is it likely to remain tough for most of this year? So in that sense, what would you recommend? What kind of exposures would you recommend, apart from what we already discussed?
Clearly, Prashant, the interest rate movements across the globe, including India, remain worrisome. We have seen 2-year yields and the 10-year yields on the US Treasury going up to levels which we have not seen for the last 15 years. Since GFC, I think this is the highest level that we have ever seen. And we have not seen the end of rate actions yet. Despite such a sharp increase in interest rates, we have not seen any impact on the economic growth rates or on the inflation trend. So to that extent, it is natural that we will see more interest rate hikes across the globe going forward. We may not see that kind of interest rate hikes in India as we already have or are close to having real positive rates. But nevertheless, I think reversal in terms of rate action is also not expected. So to that extent, whenever you have higher interest rates, that's obviously going to have some impact on the growth with a lag. And it's also negative for equity valuations. So to that extent, yes, these are not the conditions which are the best conditions for businesses or for the equity markets in terms of valuations. But within that, we believe that market has consolidated over the last 1.5 years quite nicely. We are almost at the same level as we were at the peak of October 2021, or even lower than that, I would say. So to that extent, I think the interim earnings growth has corrected the valuations. So we may not see a very big downside in the market, but at the same time, there are no real triggers for a large upside in the market at this point of time. And overall, the direction of the market would be dependent on the earnings delivery going forward. Because if you look at first 9 months, the earnings growth has been just around 9 to 10% on a year-on-year basis. But the expectations for next 2 years are at around 16 to 17% growth. If we are going closer towards that earnings growth expectations, then I think the markets can sustain the current valuations and possibly can move up. But if there is further disappointment, I think market will wait for those evidences to come through before making a new move.
Harsha, so, let's talk about something bright as we are, ending our conversation. If there's one thing that's definitely moved higher in the last several months, it's government spending, right? And that's really showing up in the award of orders and, fresh tendering. We saw that in Vande Bharat, that big order yesterday, railways otherwise, even defense for that matter. So what place does capital goods find in your funds? And how are you navigating valuations? Because some of the stocks, ABB and Siemens, for instance, they're sitting at lifetime highs now.
Surabhi, clearly the government has made its intent very, very clear during the last budget. The statement that has come out from the government shows that despite high fiscal deficit, we are not going to sacrifice our productive growth, and we will continue to focus on that. And in line with that, we have seen new orders coming through from the defense sector, from railways. And the expectation is over the next 12-18 months as well, the investments from the government side will continue to be very, very strong. So we clearly believe that we probably have made a bottom in terms of the investment cycle. What we are seeing now is clearly an uptick in the government spend. But slowly and steadily, we also expect private spend to pick up. It's already happening in a couple of sectors, but all-round capex growth is still not visible. But we do expect that to happen over the next few quarters. And the household investments into real estate also continue. So across the board, I think investments are happening at reasonable levels. And that is definitely positive for all the companies which are closely linked to the investment cycle, be it banking in terms of the credit growth, be it industrials, engineering, cap goods, all of these sectors. Yes, in some of these pockets, obviously, some of the expectations have already been discounted quite well. So to that extent, you won't see a uniform level of valuations. So wherever you are not comfortable with the valuations, obviously, you need to be careful. But overall, as a business, these sectors look reasonably well placed for the next 3 to 5 years.
Okay, all right. Harsha, before we let you go, we spoke about one pillar of the market, that's the Nifty Bank, and you like the large private sector names that you just told us. What about IT? In the past, you've said, no, you want to stick to the domestic names and they find preference over IT. But what's the stance now on IT? Will you look to selectively buy into some of those stocks?
Nigel, still the preference is for domestic businesses. Clearly, as I mentioned, interest rates are still moving up. We really have not seen a big dent in terms of economic growth or inflation in Western markets. So to that extent, interest rate actions will continue, which is not only negative for growth, which will have repercussions on the discretionary IT spend at some point of time, but also it's negative for equity valuations. And usually in a scenario where equity valuations are unlikely to move up, you will see pressure on some of the high multiple or high growth segments. So to that extent, clearly those businesses which are trading at higher than market multiples will continue to have some pressure on valuation. And IT happens to be one of those. So yes, we are not completely negative on the sector, but as a preference, we prefer some of the domestic businesses where we believe that there is room for valuation re-rating as against IT, where we believe we may not see that kind of a re-rating in multiples.
Okay, Harsha. Got that point. Thank you very much for joining in today. Always great to have you on the show. You have a great weekend, and we look forward to our next conversation. Well, the bulls looks like they're going to have a great weekend as well, Prashant, because this market, at least for the time being, is really building on the momentum. We are seeing about almost 1% up move, very comfortably above the 200 DMA. So that's one level, obviously, that's being held quite well. As of now, we'll have the gainers up for you on the screen. Adani, yes. SBI is adding more weight. Reliance